Hi guys, so you would have often heard statements like that if you run 10,000 rupee SIP for a period of 30 years, then you will end up having 30 crores. Some people will show you computations like, okay, I do SIP of 50 lakh every month and my portfolio will become like, I don't know, richer than Warren Buffett or something. These are the type of clips that you will end up seeing. So just watch it very quickly, then I'll come back to the topic.
10-10 हजार की अगर SIP 95 में आपने चालू की होती तो पहले 15 साल में आपने कुछ लगभग 18 लाख रुपए डाल दिए, उसकी वैल्यू 3 करोड़ रुपए हो गई थी फर्स्ट 15 इयर्स, विच इज अमेजिंग। 18 लाख का 3 करोड़ हो गया। मजे की बात देखिए, अगले 15 साल में आपने और 18 लाख डाल दिए, आज आपका टोटल फंड का कॉर्पस 20 करोड़ प्लस हो गया है।
Now, after watching these clips, you would have a natural response that, okay, boss, SIPs are great. Let me put crazy ton of money to become the next Warren Buffett. Now, is this the reality? The short answer, according to me, is a strong no. SIPs will not make you rich. I will show it to you with mathematics. I will show it to you with logic. And also, I will show you the solution that if you want to become rich, how much rich can you realistically become by doing what, right? Everything will be backed by logic. Now, this is my viewpoint. This is not the viewpoint. Please listen to both the sides of the stories because at the end of the day, you are working hard. You're going to a job, going through so much grind and putting your money in an instrument that you think is going to make you rich. So at least give me 5-7 minutes of your life to at least build my case, and then whatever you feel like doing, do it. Okay, it's okay. And just very quick note, many of you would say that, hey, Akshat, what are your qualifications? See guys, here is my portfolio, which I built like this year. And honestly, it's beating almost all the mutual funds in India. So it's not as if that, I'm underperforming in the market. I have consistently performed well in the market. Education wise, I am CFA level 2. I have done an MBA from one of the world's best institute, which is INSEAD Business School. I've worked with top consulting firms. I manage money now. I run my own fund. I have worked across different parts of the world. So I'll speak with logic, rationale, with experience. Okay, so let's begin without wasting any time. And let me first and foremost show you this data point and this rough computation. So this is a tweet that I did. And basically what it says is that if you run an SIP of 10,000 rupees for a period of 30 years, and if the growth rate of that fund or that SIP is 12% returns. And why have I assumed 12%? Because this is the industry standard for large cap equity funds, that on an average, they will grow at roughly 12%. Now, if you're doing small cap, mid cap, you might get greater growth, but it comes with a higher risk. So for the purpose of computation, we will assume that you're running SIP on large cap mutual funds. Okay. So then what happens? That your total investments over a period of 10 years would come out to be roughly 36 lakhs. Your total returns compounded at 12% CAGR comes out to be 3 crores. This is amazing. That 36 lakhs of investment almost becomes 9.5 times in a period of 30 years. That sounds really impressive. And it's 3 crores. But here is the gravitational pull on it, or the negative things that happen to that 3 crore portfolio. So number one thing is that you will have to pay commissions to mutual fund companies जो दिन भर बैठ के podcast करते रहते हैं. So you would end up paying at least like or roughly around 1% commission, right? So that's the assumption. So then your corpus falls to 2.52 CR. Okay, so this is one. The second and the bigger gravitational pull is called as inflation. Inflation means that with time, your buying power gets reduced. So there is no honestly legitimate figure that we can put for inflation in India, because this year they have said that CPI inflation is 1.55%. This makes no sense. But if you do run your mathematics, that at what rate the flight prices are increasing, what rate private education is increasing, what rate your rent is increasing, then roughly you would understand that for people doing SIP who have discretionary income, that number will be very high. Okay, so I'll come back to that in a minute. But let's assume 6% inflation. That's a reasonable number to assume in a general environment or economic environment in India. So as a result, that 3 crore, actually the real value or real buying power become 44 lakhs. Now also the returns that you make, you have to pay long-term capital gains tax on it. Now, right now this is 12.5%. So we adjust this further. So what is the amount that we are left with? So in total, after deducting everything, we end up making 38.51 lakh rupees on an investment of 36 lakhs. So let me run through a couple of more scenarios to help you understand, because some of you would say that, okay, we get like LTCG benefits also, that up until 1.25 lakhs, we don't pay any LTCG tax and all that. So now there are many variables here, right? So let me show you that picture also. So, okay, so here I have done another layer of computation. So here the total investment amount remains approximately the same, right? So corpus after commission, nominal means that we have not adjusted it for inflation. So this becomes 2.52. Gains after commission becomes 2.16. Okay, so LTCG after 1.25 lakh exemption becomes 2.15. LTCG paid this much, corpus after tax nominal this much. So inflation adjusted at 9% comes out to be 45 lakhs. Now, why have I assumed 9% here? Because honestly, the number should range, the inflation number should range between 6 to 9% for people who have discretionary income, who are taking flights, who are availing private education, healthcare, etc., etc. 9% is a very reasonable estimate. So if we adjust for, so here we can work with a range that if you are investing roughly 36 lakhs, then your money can range somewhere between, let's say, 45 lakhs all the way till 75 lakhs. That's a real buying power after 30 years of that 36 lakh rupees, depending on how you're looking at inflation. Long story short, here is the key takeaway and the problem that you will witness in the next 30 years, that inflation in India will be high. The SIP returns, if you're not able to generate higher SIP returns above 12%, then you will be in a soup. Okay, so this is a problem one. The second key problem that you will face is that there is no handle on 12.5% LTCG. Why? Because before 2018, the LTCG tax on equities was 0%. Now it is 12.5. First is for jack to 10%, right? Then now it has gone up by 25% in 2023 to 12.5%. So what is the guarantee that after you running another 5-6 years of SIP, the government will not come out and say that, you know what, pay us like 15% LTCG. So what's the solution there? And by how much does your real buying power come down, right? So this is the second key problem. The third key problem is the commissions problem, that you don't know how much you would be forced to pay as commissions because they will keep on increasing their expense ratio if they feel like. That's another problem. So there are a series of complications that come, but long story short, realistically speaking, if you invest 36 lakh rupee in SIP over the next 30 years, as per current standards, you can realistically estimate it, the final value, the actual money that you can expense out to be between 45 lakhs all the way till 75 lakhs. So this is the real computation. It's not as if that 36 lakhs turns into 3 crores. 36 lakhs will only maximum turn into maybe like 75 lakhs, right? Over a course of 30 years in real buying power terms. I hope that this point is okay. Now, second key point that comes into the mix is that, okay, you have scared us, right? What's the solution? So, okay, so I already told you the solution. So I'll just bullet it out and take you through some of the finer points around it. So number one point is that if you want real wealth growth, then you have to grow money much faster than inflation right now. So I'll speak about this, but the goal one becomes that your money should be growing or your SIP returns should be growing at a much faster pace than 12%. If you do the computation at 15%, then what are the returns that you make? So here is the summary note that I have prepared, and in this computation, the only thing that I have changed is the rate at which your money grows. So in the previous calculation, we have assumed a 12% growth rate of your SIP. Here I am assuming a 15% growth rate. Now what is the corpus change? So here the corpus actually goes to 72 lakh instead of 45 lakh. Now compute the percentage difference. So it's approximately 65-70% up. That's the corpus difference on a 3% change in your return equation. This is the number one point, the most important point, that instead of targeting a 12% growth rate, you have to target a 15% growth rate. So what I'm trying to tell you is that our brain is not wired in terms of thinking about compounding. 1-2% difference does not look much to us. We end up paying crazy amount of commissions. We don't focus too much on return generation. So these are habits that we need to kill if you truly want to become wealthy in terms of running your SIPs. So I will just suggest 6 solutions to you. That's it. So 6 solutions. If you listen to this, hopefully it will help some of you, right, who are watching this video with an open mind. So solution number 1 is that go to superior markets. Now, what is the meaning of going to superior markets? So here is a basic computation. I'm not trying to fool you or do any kind of hoodwinking. I'm just genuinely telling you data. Go on Perplexity, go on any chat GPT or Grok, whatever you use, and fact check this. For example, look at the returns of Nasdaq Composite. Now, Nasdaq Composite is the tech index in the US. In dollar terms, it will grow somewhere around 16 to 17%. These are some of the CAGR returns on 1, 3, 5, 7, 10-year basis. You can check, you can take an average, and you'll figure out that this number comes out to be 16, 17% in dollar terms. Naturally, now people say that, okay, why are you doing like dollar return? We live in India, we don't need to expense things out of India. Why? Because what I've shown you, inflation computation, that gets added to what? To your overall returns. Okay, so for example, in inflation, technically in the US is low also. Okay, so yeah, so you have to compare a baseline return. So always look at returns in anything in a same currency basis. Either you convert Nasdaq into INR or convert INR into US dollar types. Okay, so this is important. So here, what is the return difference that you will make if you just simply decide to run an SIP on Nasdaq? There is at least a 4-5% in dollar terms. Okay, so this is amazing, right? So many of you get scared that, okay, if I go to the US market, then I'll have to pay 20% TCS and all that stuff, remittance cost ho jayegi and all that. Even adjusting for 20% TCS, even adjusting for remittance cost, still the overall returns over a 30-year period comes out to be much superior. More important question here is that why does that happen? It's very simple. Now let's look at the American market itself. So if you consider the returns of M7 stocks, it is much, much higher, almost 3 times higher than S&P 500 companies. Now, why is that the case? That M7 stocks or top 7 companies or tech stocks in the US, they are growing faster than other listed companies in the US. Or other way to look at this is that, okay, tech in the US is growing dramatically, but other sectors in the US are not growing at all. So when we speak about that, okay, US economy is going to go under, kuch nahi bachega, everything will go bonkers there. Kind of true, but not true for tech. So tech is a oasis in the desert called as the US. Okay, so that's a shining light or bright light that is there. This part of the US industry, which is tech, it is just pulling the weight of the entire US economy. Now, you as a stock investor have the option to invest in the broad market, the entire S&P 500, or you can go to a sub-segment or sub-sector within the US economy, which is tech. So my advice is go to tech. Why? Because it generates superior return. Going forward, almost all the things will be driven by tech. We are in tech revolution 2.0. The first tech revolution happened in the dot-com crisis era, right? I mean, early 2000s when Amazon and all these companies came, they changed the world. Now, due to AI, the world will be changed. These are useful technologies that are impacting you. You are using more LLMs now. You're using more photo editing AI software. The copywriters are going out of jobs. Why? Because of the increased usage of AI tools. So number one point is that please buy more tech stocks. When I say tech, I mean foundational tech, high quality US tech companies, which are going to lead the next generation of technology. Despite TDS, despite commissions, remittances, everything included, 17% CAGR versus 12% CAGR in INR terms here, which is equivalent to like 8% CAGR in US dollar terms. Huge difference between the two. Nasdaq is almost growing at double the pace compared to a general SIP doer in India. Okay, so this is one. Second key point, that try to pay lowest possible commissions. For example, if you're buying an SIP in India, right? For example, if you're buying an SIP in a large cap equity mutual fund, then the expense ratio will be higher than that of Nifty 50. Now, Nifty 50 is a passive mutual fund or a passive fund. Now, when you are buying a passive index, passive means that the mutual fund manager is not doing much there, right? I mean, he's just mirroring whatever companies are there on Nifty 50 and buying that. So since their work is less on that, they don't have to go and hunt for companies. The commissions that they can charge on Nifty 50 products or mid-cap 150 products or small cap 250 products, that is much, much lower. So try to buy passive funds. That's advice number 2, because your commissions will be lower. Now, here is a quick computation on how much difference does 1% commission creates on your corpus. If you compound it for 40 odd years, the difference in just by paying 1% commission could be a change of 33% of your portfolio. Okay, so you might feel, yeah, I'm 1% commission, so a 1% commission only I'm paying more, so what's a big deal? The big deal is that, the change in corpus is like 33%. Okay, so that's huge amount of money you're losing just by paying more and more commissions. Number 3 point, you can do something called as capital rotation. Now, what is the meaning of capital rotation? So for example, if I take you to this, so right now I'm aggregating a lot of Amazon stock. Why? Because of capital rotation. So for example, if you consider the journey of Amazon from a technicals point of view, you will see that Amazon has been trading in this channel, right? It is going up and down like this. So whenever it is at a support, that's a good time to add Amazon, right? Whenever it goes up, this is a good time to sell Amazon. So what I'm going to do, so I'm going to do a bulk buy here, right? And whenever I get an opportunity to sell, when it starts trading towards the top end of the channel, I will exit. Can you do this with all stocks? No, you cannot do it with all stocks. The stock has to be high quality. You have to run fundamental checks. You have to do a bunch of things. But what ends up happening is that, let's say that if I'm able to rotate capital on a good stock like Amazon and make, let's say, 35% return. 35 is to zyada ho gaya, right? I mean, let's not even assume 35. Let's say 12%, 13% return, right? So I make it once, but I make it every 6 months. Then because I'm able to rotate my capital into Amazon twice a year, or a stock like Amazon twice a year, what is the return that I'm actually making? I'm making 24% because I have been able to rotate capital twice. I feel that this is going to be one of the defining features of good investors, that whether or not you are able to rotate capital. Point number 4, that you need to have assets which have fixed supply. I'll say something, people will get pissed off, so be it. For example, Bitcoin. Now, why Bitcoin? Because the rationale is that it is a fixed supply asset. There is literally only one asset in the world right now which has a definitive fixed supply, which is Bitcoin, because I can tell you that there are only 21 million Bitcoins. I've been saying this from the year 2021 publicly, right? That I'm adding Bitcoin, I'm adding Bitcoin. I started buying Bitcoin when it was at $3,500. Now it is at $123,000. In fact, it breached $125,000. It's crazy run up, right? That has happened on Bitcoin. But what people miss is that, hey, it's speculative. It is speculative because it is a newer asset class. Learn about a newer asset class fast. And if you can afford to even put maybe 5% of your capital, that's good enough, right? Because that 5% capital might turn out and make your entire portfolio 50% of it. Okay, so 5, if it goes 10 times, it becomes 50%. So this is crazy run up for very little risk. Bitcoin is $1 million bet or a $0 bet. There is nothing in between. I'm not trying to oversell Bitcoin. But the message that I'm trying to tell you is that you need to have some kind of fixed supply asset in your arsenal. If you don't know about Bitcoin, if you don't know about tech investing, I do run a global investing community. In case you guys are interested, do check it out. Returns have been exceptional. I will continue to run these public funds, continue to reveal performance, because I want to prove to the world that normal retail investors can actually beat sitting mutual fund managers easily, right? It's not complicated at all. I have been saying it publicly. I am now doing it publicly, and I will continue to do it. It's not ego or anything. It's just simple mathematics. Stock investing is a probabilistic kind of a thing, okay? Next point is that please do not buy the market when it is hyper overvalued. For example, here is the PE ratio of mid-cap 150. Many of you are excited to buy mid-cap 150 stocks right now. I have not added mid-cap 150 or bought too many mid-cap or small-cap stocks for the last 1.5 years. But I was one of the early guys who put big money on mid-cap, small-caps in 2023, made 100% returns, and I was out. Why? Because you just need to track basic things like PE ratio of mid-cap stocks, or in general, or small-cap 250 stocks. So what you would find out in 2025, the ratio for mid-cap 150 is 33.4. In fact, it had gone up to 37-38 at its peak. Now, what am I saying, right? So here, for example, if you take a look, right? So here, when the market had gone up in September, October of 24, it was above 40 at that point in time. So charts were telling us to sell it, right? And if we sold it, learned a little bit about momentum, learned a little bit about PE ratios, then you could have avoided investing in an overvalued market. So you'll not get this right every single time. It's complicated to get it right. Sometimes you will miss the bus. But now, because almost 1.5 years of consolidation has happened, you can start building positions here. Okay, so this is something that can be done now. So now is a good time to start adding like mid-cap 150 stocks, because if the earnings improve, right? Earnings improve, then PE ratio will come down, right? So that's what mathematics tells us. So long story short, you have to avoid the market when it is trading high, right? So this is a very important point. Final point is that please be diversified, because inflation hits different countries very differently. Inflation is about to hit India really badly over the next 5-7 years. Why is that the case? Because we are already seeing it. US is great at exporting inflation. Where does it export inflation to? To countries like India, emerging economies, Sri Lanka, Pakistan, other emerging economies. So emerging economies get hit harder by inflation. This looks counterintuitive. Maybe I'll make a video on this. But long story short, as inflation grows in the world, emerging economies are going to hit harder and harder. There is a post that I had done on stable coins, that how US is about to use stable coins to export inflation faster across the globe. Maybe I'll make a video on that. But these are 5-6 points that you need to keep in mind if you genuinely want to build your wealth through SIPs. If you do SIPs on the wrong product, if you don't understand basics of market timing, just invest in fixed assets like land, or somewhat fixed assets like land, gold, Bitcoin, etc. You will be much better off. Thank you so much for watching. If you enjoyed the video, do press the like button, and I'll see you soon.